In 2026, three memory chip manufacturers are on pace to generate $350 billion in combined net profit. Samsung is projected to be more profitable than Alphabet, Microsoft, and Apple this year. A year ago, it ranked 16th. The high margin side of the technology business has just changed. I'm John Cervantes. This is the Practitioner's Brief, and this is part 2 of a series called What Your Portfolio is Actually Made of. In part 1, I showed you that 92% of the S&P 500's value sits in intangible assets: software, algorithms, intellectual property, a half-century of asset-light dominance that rewarded businesses with predominantly digital footprints. No factories to maintain, no equipment to replace. That was the market's preferred model, and it worked. But three things are happening right now at the same time that are flipping that model upside down. First, the companies that defined asset-light growth are spending like industrial conglomerates on chips, on data centers, and on power. Second, the most profitable products in the global economy are no longer software. They are physical components. And third, a competitive dynamic between the largest technology companies is ensuring that the spending cannot slow down. Let me walk you through each one. Before I get into the numbers, I want to zoom out for a second because none of this is actually new. The technology may be new, but the pattern is not. Capital investment cycles are generally tied to major technological shifts or structural demographic waves. We've seen this before. The railroad boom in the mid-1800s, the telecom and internet build-out of the 1990s and early 2000s, the commodity supercycle of the 2000s led by China's construction boom, the housing supply boom that led to the 2008 Great Recession. Each of these cycles differed in size, scope, and importance, but they all shared similar features. Excitement around a new technology or trend drives capital to be invested because of the prospect of high returns. More capital chases those returns, creating the boom, and ultimately the oversupply. Capital gets destroyed, businesses fail, industries consolidate until supply and demand can find some sort of balance. In my opinion, we are deep in the AI investment cycle right now, and the ultimate benefit of this technology will flow to consumers. There may be just some bumps along the way. So how big is this cycle? Let me give you a number. Morgan Stanley estimates that tech companies will spend $2.9 trillion on chips, servers, and data center infrastructure between 2025 and 2028. $2.9 trillion. The asset-light era is gone. All that matters now for investors is what the return will be on these investments. That is the question, and we can only speculate on those answers. In the first quarter of 2026, the earnings season pointed to more investment. Let me give you some highlights directly from the earnings calls. Microsoft said they expected to invest roughly $190 billion in capital expenditures for 2026. That was $35 billion above Wall Street was expecting, and $25 billion of that increase is just from higher component pricing. And they said they remain confident in the return on these investments. Meta raised its capex guidance to between $125 and $145 billion for 2026, up from an already elevated range. The reason? Higher component pricing and additional data center cost. Amazon was the most candid. They said, and I'm paraphrasing here, the faster AWS grows, that's Amazon Web Services, the more short-term capex they have to spend. And they acknowledge that in periods of very high growth, like right now, where capex growth outpaces revenue growth, free cash flow is challenged. Those are their words, free cash flow is challenged. Now here are two trends that matter most from the latest earnings data. Number one, hyperscaler capital investments. That's Microsoft, Amazon, Google, Meta, and Oracle are now approaching 100% of operating cash flow in 2026. They were at 70% in 2025. Think about that. They are spending everything they generate. And if this is going to continue, how much debt will be needed to be issued to continue this cycle? Number two, earnings estimates for the Mag 7 and technology continue to move higher. Free cash flow growth? Not so much. The reason? Accounting. The cash is spent, but the investment outlay is not immediately expensed. They are depreciated over the investment's useful life, smoothing out the cost. This is why we're seeing so much debate over the useful life of semiconductors. But nonetheless, every year these investments are made, it structurally rises depreciation expense. Meaning as time passes, so does the requirement for seeing a return on these investments. So the immediate impact to earnings is limited, but the pressure to meet these return thresholds rise. So what has all this spending actually created? This is where it gets interesting. For a generation, physical manufacturing was the low margin side of the technology business. Software was the high margin side. That relationship is inverting. As reported by the Wall Street Journal, Samsung reported first quarter 2026 net profit equivalent to more than $30 billion for one quarter. That nearly matched the company's previous record for an entire year. 94% of Samsung's operating profit came from semiconductors. Samsung is now projected to be the second most profitable public company in the world this year, passing Alphabet, passing Microsoft, passing Apple. A year ago, Samsung ranked 16th. Samsung, SK Hynix, and Micron, the three primary DRAM memory chip suppliers, are collectively expected to generate roughly $350 billion in net profit for 2026. Each company is now projected to be in the top 10 most profitable companies in the world, second, sixth, and ninth, respectively. Last year, they were 16th, 18th, and 49th. These are mind-boggling changes. This shift in profitability has driven an explosive move in semiconductor stocks beyond just memory providers. It's to a level that whispers bubble. Impossible to call, but the price action is in rare company. It's joining the ranks of other notable bubbles, the roaring 20s, Japan's explosive stock market moves in the 80s, the dot-com era. And remember, bubbles can only be called after the fact. And remember, profits for these companies are also soaring. The question remains of their durability. So why is this happening? And more importantly, why is it unlikely to just stop? Every earnings call of note delivered the same message in different words. The spending is going to continue. This is a classic prisoner's dilemma. The hyperscalers are all competing for the same AI infrastructure position. They cannot individually pull back and risk losing ground to each other. Or worse, they risk technological obsolescence. The cost of falling behind is existential. So it is in each company's best interest to keep spending. But in doing so, they collectively risk oversupplying the market and limiting the returns for everyone. No single company can stop. And that structure of the competition says they will not. And here comes the new entrants. Cerebras, a chip company built specifically for AI, debuted on the NASDAQ last week. We are also expecting Anthropic, OpenAI, SpaceX, which now includes xAI, to IPO this year or early next. So the question remains, what is a thoughtful investor or retiree to do? I'm John Cervantes. This is a practitioner's brief. The full written brief with sources is linked in the description. Thanks for watching. Have a great day.